Today we're going to talk about whether you should draw from your RRSPs early to delay CPP. After helping hundreds of Canadian retirees optimize their plans, we always get asked how to time these withdrawals to maximize retirement income. And that's exactly why we're making this video. So you can strategically incorporate your RRSP and CPP into your retirement plan instead of second guessing whether you made the right choice. Let's get right into the video.
This has become the age-old question that a lot of retirees continually keep asking, is when they should start taking CPP versus when they should start taking from the RRSPs. Many Canadians are unsure whether they should draw from the RRSPs early to delay starting to collect CPP. That fear of delaying CPP means that you're leaving money on the table. And I find some of the main issues are people don't fully understand how RRSP withdrawals impact their overall tax situation and their retirement cash flow. Some people see CPP as a guaranteed income source, but don't weigh it against potential RRSP growth and potential taxation they might be dealing with. The lack of a clear strategy to optimize both the RRSP withdrawals and CPP benefits for long-term financial stability is probably the underlying issue that we continually see. I think it'd be good to start with some of the underlying beliefs that people have in regards to this issue around RRSPs and CPP withdrawals. So oftentimes people have the same belief of it's always better to take CPP early as is possible to get more payments out of it. Obviously, you can start at 60, take it at 65, or potentially defer, and people tend to lean more towards taking it early. Withdrawing from RRSPs early means that you're losing out on money, and that could be from a taxation point of view, that could be in terms of potential long-term growth. Sometimes delaying CPP isn't worth it because I might not live long enough to see the benefits. Should I avoid paying taxes now, even if it means I pay more taxes later? These are some of the main issues that people are dealing with, and that delaying of taxes is one of the main questions that people have.
As you can see, improper timing of your RRSP and CPP can lead to a lot of unwanted surprises during retirement. So if you want more info on how you can time yours correctly, click the first link in the description where you can watch a video on the exact system we use with our own clients to help secure their retirement. Now, John, you've mentioned a lot of these false beliefs that Canadians may have about taking RSPs first, taking CPP first. What are some of the negative consequences that surface when people believe these beliefs?
Yeah, well, first of all, they may end up in a higher tax bracket in their 70s and 80s due to forced RRIF withdrawals. They may risk losing some valuable government benefits, old age security being the main one, due to higher taxable income in retirement. Their investments might suffer from poor timing, leading to lower long-term returns. Could be facing financial stress in later years due to the lack of guaranteed income that they might receive. And they might unknowingly pass up the opportunity to significantly increase their lifetime CPP benefits. Biggest question we have is always around the taxation of things. And if you're avoiding paying it now, you're gonna have to pay it later. And oftentimes that's where people run into issues later in their life that could affect themselves in some of these ways. So knowing this now, Carlo, how should people time their RRSP and CPP withdrawals?
Well, John, as you can imagine, everybody's situation is different. Factors like current income, age of retirement, other assets, and life expectancy all impact the best strategy. As you can imagine, there's no one-size-fits-all approach. Some people benefit from early RRSP withdrawals, while others should wait. Optimizing withdrawals prevents tax inefficiencies. So without a plan, retirees might pay unnecessary taxes or miss out on government benefits. If you strategically time your withdrawals, it can smooth out income. That can mean balancing RRSP withdrawals with CPP, and it can prevent sudden tax spikes later in retirement. I think the right approach ensures a more predictable retirement income.
Yeah.
You reduce the dependency on volatile markets and making cash flow more stable.
Now that you know the importance of planning your RRSP and CPP according to your exact situation, we're going to walk you through step by step how we helped one of our clients time this correctly. By the end, you'll have an understanding of how to implement this in your own plan. So let's get started with an example of something that we've walked through with some of our clients that maybe can be beneficial to some of our viewers watching today. Let's use hypothetically two clients, Gary and Susan. They're both in their mid-60s, called 63, and both are going to be retiring this year. They have a family, a couple adult children that they are still somewhat supporting, and now that they have moved out of their home, Gary and Susan's biggest concern was generating enough income throughout the retirement. But because they have kids, they did want to leave behind an estate to pass on to their children. So the original expectation with CPP and RRSPs is they wanted to take money from their RRSPs from the moment they retired at 63 and defer taking Canada Pension Plan until they hit the age of 70 in order to maximize the amount that they would be getting from the Canada Pension Plan. The RSPs were approximately $500,000 in value, and then they had some tax-free savings accounts, but ideally did not want to have to utilize those for retirement. They also are going to be getting Canada pension, like we mentioned, old age security when they turn 65, but no company pensions. So their original strategy was beginning to utilize their RSPs in order to supplement their income or provide them an income throughout their retirement. Their goal was to push off Canada Pension Plan for as long as possible, but start to receive old age security at the age of 65. From a tax and cash flow point of view, there wouldn't be too many issues. They would be able to draw money from their RSPs exactly how much they would have needed. They probably would draw them down a little bit more aggressively, probably than they would have liked to. But it does give them the opportunity then to defer their Canada Pension Plan for as long as possible. But there was one major issue that does come along with that plan. As I mentioned before, they have some adult children that they do want to leave behind an estate to, RSPs being a part of that. So in turn of not taking Canada Pension Plan for the next 7 years of their retirement, they are forced to draw down more from their RSPs than one originally thought. If you think about it from both of their perspectives, even as a rough estimate, call it $1,000 a month, each of them would have been receiving from Canada Pension Plan. It's $2,000 a year. That's an extra $24,000 of withdrawals from the RSP, from not only in that given year, but also over the course of the next 7 years in total, upwards of $150,000 that they would have had to take from their RSP prematurely. Now, that does have a big impact on their overall plan. That just means there's going to be a lot less to leave behind once the kids come around. And Canada Pension is not something that you can pass to the next generation. You're able to pass a portion off to a spouse up to a certain maximum, but even then, not a lot to leave behind, whereas RSPs are much more flexible in that manner. So Carla, maybe we walk through what are a couple of long-term benefits that these clients would experience just by changing their plan in terms of when they take RSPs versus CPP.
Well, John, as you discussed, with CPP benefits, there is no survivor benefit beyond a spouse. And if one of the intentions was to help benefit their adult children, that's going to be passed down to them through the RSP, through the beneficiary designation. So by supplementing their other income sources with the CPP early, they're allowing their RSPs to grow longer and remain in the RSP so that when they did pass away, their funds would be directed to their beneficiaries, which would be their children. Although there would be an increase to the estate tax bill when the parents were gone, because as you may know, an RSP is fully taxable in the year that the annuitant passes away. So depending on the value of that RSP, could push them into a higher marginal tax bracket. But at least you can direct the balance of the RSP to the adult children, whereas, as we mentioned, there is no CPP benefit for beneficiaries beyond a surviving spouse.
That's exactly it. And even to in addition to that point, to potentially avoid a large tax bill upon the estate, there is the ability, and we've done videos on it in the past, where you are able to kind of melt down that RSP in still a tax efficient manner, maybe taking more than they need to in their 70s, 80s, and maybe potentially 90s, and start moving some of that money over to tax-free savings accounts, which you'll continually accrue room. So there's a lot of strategies that you can utilize to avoid that big tax hit come the estate. I think that's the biggest concern a lot of our clients deal with, is they want to take the RSPs now to avoid having the government take potentially up to 53% of it through the estate. But there's other strategies to do it. Doesn't mean you have to only defer CPP and whittle down your RSPs early. There's other opportunities you can have based on your life expectancy and the amount of years throughout your retirement.
By now, you should know whether you should draw your RSPs early to delay CPP and the key factors that play into this decision. As you saw with our client, there are many choices to make based on your personal situation. That being said, it's important to understand that you can't properly optimize your retirement income without knowing exactly where you stand. That's why we created a short video to help you assess your needs and properly time your RSP and CPP using our very own retirement system. To watch it, just click the first link in the description. We'll see you in the next one.